as we talked about, and Lindsay, the biggest thing is we went over last week, and we kind of preached this, a lot, is just the rule sets that we have that we definitely have to follow, and they're certainly there for a reason to help us make wise decisions. And we've all had our growing pains, and we've probably all done some things that, sometimes failure is the best place to learn, and you learn the most there. And so when you're doing this paper trading, yeah, you're going to make mistakes, and that's certainly really important to learn from, and learn the word patience as much as you can. So in any event, here we go. So setting your rules. As Craig went over this last week, we want our OTMs, your premiums. I had a conversation with a guy today, and he was trying to figure out whether a certain trade was going to be good for him in gold. And I think Tom put on a 3150 today, or a 3145. I'm not sure what it was, because I'm not ready to put any trades on right now, so I just didn't follow it. But he asked me, well, what do you think I should do? I said, well, he says the BP is really, really high. I'm getting around 13-14%. I'm like, okay, do you have any positions already? And he goes, yeah. And to what Tom was saying, and a lot of us say, is that he was balanced. He had equal puts to calls. So this next call or put was going to bump his BP up. But what we ended up deciding is that it wasn't a good trade for him. As much as you want to follow all of Tom's trades and follow Tom's rules, if you don't have the dry powder to follow Tom's rules, that means you shouldn't do that trade. And that's where the patience come in, because, there's always going to be another trade. But if your BP, like today, I'm sure, like some of you that are on the call, your PP was kind of humming pretty nicely. And then gold and silver, for those that were in that, kind of got a nice little spike today. And it spiked, 4,000 or 5,000, depending on your positions and your account size. But it's certainly, you woke up to a different number than you were expecting. And that's where patience come in too. If you're over 50, yeah, I wouldn't do a thing. I would just hunker down until things settle down, unless you're about to put another big piece do another, if you're about to, put some more money in your account, then I'm not doing anything. And when you look at Pete's sheet, another thing you can do is, when you analyze Pete's sheet and you look where Tom is on his BP effect, look how many times Tom actually puts a trade on when his BP is above 50%. How often do you think he does that? Never. I don't think he ever does. I personally have never caught that. I don't know if anyone else has. But when you start to see a lot of yellow and it's ticking above that 50%, I'm not sure I'm seeing Tom do much. Now, that thing drops down below 50 and is hovering around that 40. You bet your butt he's looking at a bunch of different opportunities out there, and he is being like a sniper sitting on top of a ridge, just looking for the best trade for himself at that point in time. And that we are just very strategic sellers of options. So, any questions from what Craig went over last week on this page? I mean, for most of us on this, a lot of us, this is going to be old hat, but there's a couple pages. The second page I think is pretty cool. And the last time we went over this, I thought it raised a lot of good questions, and that's asset allocation. And we want to diversify our portfolio. We don't want to be 100% or 80% or 70% in oil and 10% here, because if oil takes a dump on us or turns our head upside down, well, we might have a little bit harder time coming out of that one in the green than we would if we were, if we had a nice balanced approach across a few different commodities. Now, I do believe, in my opinion, if you have a smaller account, it's harder to have 3 or 4 different commodities to play in. Maybe it's only 3. Maybe you stay away from gold because of the amount of BP it takes. There are different things that you can look at to allocate to diversify your account. So you again be strategic in how you do that. Because if you maximize your wins on one, you can also maximize your losses. So just be careful on it, and have some rules sit on your table. Know what percentages you want in each one of these markets, whether it's 30 30 30 or 33 33 33, whether it's if you still want to be a little bit heavier in oil, just don't be over 50%. If you want to be a little heavier in gold, just don't be over 50%. Just really try to balance your strategy, and you're attacking different markets. For example, in my Aprils, I don't have any golds or silvers right now, and I have live cattle and I have oil. And I was most likely going to do something different, but live cattle took me in a different direction. And so because I had a bunch of dry powder and I just wasn't ready to do anything in the other two, it saved me to be able to manage myself through those live cattle and not just trying to be, very anxious to get trades put on. So,
hey, Troy, yeah. What made you decide to get into cattle? Because I don't remember Tom actually ever deciding to do that.
Tony, it's live cattle is fascinating since the day I started. And I when I don't know what I want to do next, and I don't want a high BP, and I want to just get a little bit of premium because I only got so much room I want to work with, I always look at live cattle first. I just have. I have very little live experience in grains. I got burnt on my first grain, and it wasn't really a bad one. It just wasn't great. And I don't know. Grains I play with grains in my paper account, soybeans specifically. But I always go to live cattle first. I don't have an answer why. Maybe I like a great prime rib. Maybe I make a great fillet, good beef tenderloin in the sous vide.
Hey, some of us haven't eaten dinner yet, so let's stop that.
But
Troy, Tom never did make a trade in the last 6 months in cattle. What you just decided to go?
I do. I don't necessarily. I use Tom as my barometer, but I am in different markets that Tom's in. I just, like I said, he hasn't been in soybean in a while. He hasn't been in wheat in a while. He hasn't been in live cattle in a while. He's been concentrating on oil, gold, silver, and 30-year bonds. And he hasn't messed around the grains or the meats lately, or their livestock. So I have seen him have livestock, like maybe last spring, maybe March. I think he had a livestock. But yeah, it's just one of the ways that I like to, diversify my portfolio. So every once in a while, I'll throw a couple live cattle in there. I've never done lean hog. If I do anything, if I do any grain, it'd probably be soybean. I've seen corn do some crazy things, and I don't know. There's no rhyme or reason to it. I was just like, I'd rather do soybean. So I watch soybean. I watch live cattle. I always have those two in my paper account as just reminders of what else I can do. And so I'm always following them in case I want to throw one on to my live account. Always.
I was looking at live cattle a couple of days ago before this sudden pullback, and I just didn't have the guts to jump in. I saw it go above the Bollinger Bands, and I thought, man, that thing's shooting straight up. And it's human nature to say, well, we ought to be buying puts here, but really what we ought to be doing is buying a call, but I didn't have the guts to do it.
Buying the call or selling the call?
I'm sorry, selling the call. When it just went straight up and it was above the Bollinger Band, it closed above the Bollinger Bands, I think 2 days, and I'm thinking, if I had the guts, I'd sell a call right now, but I just didn't have the guts.
Yeah, well, the one I'm in is at like 65 Aprils. I think it's 65, 64 days to DTE, and then the next one is in that's April. So the next one I think is in June, because I think it's every other month if I remember correctly. But yeah, it's been interesting to read about. Just about the heads. The heads are stable. The heads aren't. They're okay. They thought the heads were. There was all this hoopla that was going on at the end of the year about the herd has shrunk a lot, and that was what was driving it up. But the last thing I read, the herd was pretty stable. It was a little bit below last year, but nothing that would make you go, oh my, okay, I get it. But people can only afford so much on the table, especially when it comes to a crappy steak in LA that was $120. I was like, really? You're charging $120 for this bone-in ribeye? Wow. But in any event, so does anyone want to take a shot at what this correlation summary is? And give me their synopsis. So here's what we have here. We have a correlation table
between. I think it's trying to.
Linz, we can't hear you.
Hello, hello. Can you hear me?
Yep.
Oh, sorry. Yeah, I was just saying, I obviously think it's just trying to say when one thing does something, then something else does something, but I can't follow it that well.
All right. So let's just look at oil for an example. So a one-to-one correlation means if this one does it, the other one's going to do it as well. For an example, if you look at oil and oil, a one-to-one means it's 100% sure that they are going to mirror each other on their movements. Obviously, oil and oil is one because they're both oils. But if you want to look at other correlating markets, for an example, oil and natural gas, well, you would think they would be correlated, but they're really not. They're 0.23, and that's a pretty balanced way to allocate your portfolio to where you're not gonna where one thing does, if oil goes skyrocket, it does not mean natural gas is going to do it. You know, you have more correlation, for an example, in a grain at 0.79 than you do natural gas. So, you know, it's just a way to look at this chart and to make sure you're allocating your markets that are not going to swing in conjunction with each other. So like the grains, if you look at the grains and the grains, look how high these numbers are. So if you have one grain, do you necessarily need to have two other grains or one other grain? I would argue and say no. If you look at a live cattle in the grain, it's a little bit less, but the correlation's still kind of high. It's a little different, but it's higher than some of the other ones that you would see. The same thing with metals. If you got gold and silver, very highly correlated, copper, we don't mess with, but very highly correlated. So, you know, you allocate your market. I personally would account for the metals as one as a total, regardless if you're in gold or silver. I would look at it as one subset. I wouldn't look at them as individuals. So if you want to do 30%, I would add your golds and silver as one of those 30%, not as a total, not individually.
Yeah, this is like the third time you've gone over this chart with us, and I just got it. I just went, oh, now I see what this chart is. Okay, thanks.
Yeah, well, I guess 1 is perfectly correlated, and 0 would be as far away from correlation as possible.
Recommendo.
Does a really low number, like I'm looking at the 2-year bonds and the financial indexes, does that mean it moves in opposite direction, or it's just not connected the way they do it?
Just as far as I know, it's an opposite direction, but I could be wrong on that. That's what I thought.
Okay. Or maybe they consider opposite. Well, I guess opposite is not correlated.
That's not.
Actually, I'm just now noticing there's some negatives there too. The parentheses. That's right.
Oh no, I didn't see that. You're right. So they are negative. So they are. That's probably their opposite. And I've heard that right when the markets go bad, you put money in short-term money market. Well, not I've heard that. Everybody knows that. You put money in money markets. That would make sense.
Now look at this one. This was January 2000 to 2024, right? Now we're going to go to a smaller segment of time, and this is January 2019. Now they're not always the same.
Right. That's very interesting. Super interesting.
So I believe I sent this to you guys the other day, and I think it's a good way to just when you're strategizing your month and you're trying to figure out, okay, I already have my totality is $12,000 of premium or $10,000 of premiums. I have $3,000 of premium outstanding in oil, and I got $6,500 more or $7,000 more that I got to float around here. This is just a nice way to make sure you balance your attack. And again, the other part of it too, maybe the market's not going to give you some. Maybe gold's not giving it to you in that month, and maybe it's been a month of just consolidations, and you're scared to death to go up or down or do a call or put on it. Well, look at a different market and look at something that may be new to you, but you are paper trading and you're paying attention to it. For example, what I did with the April live cows, I was paying attention to it. I thought I had an idea, and I was wrong. But I've managed my way through it, and I'm not going to take a bath. So it's so far so good. Knock on wood. It's made a nice turnaround for me, and we'll see how it goes. But here's the other one. This is the last 12 months. Now, a lot of questions have come up about Tom's returns in the last year in conjunction to what's the advertising and his higher returns in some of the YouTube videos. Last year, are you there?
We're still here. We're still here.
Continue. Performance was the technical tell us.
When you get the number to call export in India, just give me your credit card.
All right.
Yeah.
All right. So in any event, here's an interesting thing. Look how much red there was on this since July of 2024. I mean, it has been a wonky year. It has not been the norm. And hopefully we start to balance this thing out and have a little bit more consistency in the markets than what we've had. Because if you manage your way through some of the stuff that we saw in 2024, you certainly learned a lot if you already didn't know it. So here's another example of that. So I would take your time. I would look at this. I would look at all 3 different charts that I gave you in different time slots, and just try to make sure you allocate yourself well And it can, if you're not paying attention to it, I promise you, you can over leverage yourself on one commodity if you're just not paying attention to what you're doing.
So, in your opinion, you showed us 3 charts. All the correlation was slightly different on all 3 charts. Which chart do you think we should go by?
In my opinion, I would look at this one because that's what we just came from, and it was a very volatile year. And I would look at this one. I would look at the 2 latest ones, and I think Robbie's going to be updating this chart too to give us a better picture of the most updated one. When I get that, I will most certainly pass it out because there's value in this chart.
So
and,
if you look at this one, you look at soy at the 1.0 soy, and go drop down below it and look at wheat. It correlates 0.82. Now go to that other chart that you had up just a second ago, right before this one.
Let me make sure I'm getting this. So you want me to go to soy to wheat?
If you look at soy, the 100% soy, the 1.0,
Yeah.
and then you drop down right below it, how does soy correlate with wheat?
No, the correlation is over.
Yeah, well, it's 0.82. Either direction you go, it's 0.82.
Oh, I got you. Yeah.
So go back to your other chart, and there's a huge difference. Yeah, that one there. Now look at soy.
0.29.
Yeah.
Big difference. You're right.
Yeah, which makes you think on this chart, yeah, I can do something in soy and do something in wheat, and they're not going to move together. So
I really believe in 2020 and 2024 there was a lot of rebalancing the spread there, the balance sheets for all these different markets, in not just commodities, but any big Fortune 500. I mean, you just saw a lot of volatility because everything, their balance sheets were way overdone from all the stuff that they were trying to maneuver their way through from post-COVID. COVID just wasn't 1 year. COVID is now just finally being washed out of our economy in perhaps 2025, 2026, in my opinion, because of everything that it affected. So to your point, yeah, I'm hoping, Mark, that the grains go back to the last chart I showed you, and it's not more similar to this chart. And I'm praying for that because this one's a hot mess.
okay.
But I'll see if I can get Robbie. I'm gonna write myself a note. Robbie. All right, I'll ask him and see what we can find and see if I can get an updated one, because it's a fascinating look. It just definitely helps you just have your system and how you place a trade. Be kind of be superstitious about it. Like, I always put my left foot on my left shoe on before my right shoe. I got little superstitions. Be superstitious about your trades. Do it the same way every time. Practice.
That's because you're a baseball player.
That's exactly what I was thinking.
Most people don't have that.
I am so superstitious. No, I'm not really. Certain things I really am. But yes, it is because I'm a baseball player. But in any event, that's pretty much it. What do you guys think? What are some of the takeaways?
Boy, one of the other ways to diversify is to take your time making your trades so that they spread out over several days or several weeks. And I think that's a great diversification also.
I agree, T. I agree 100%.
I'll bet if you follow this, very confident if you follow this and try to keep things distributed using this for risk management, you'll get better margin. I know they use this when they calculate span margin. I don't know the details of their algorithms, but I know they use this stuff.
All right.
No, I think when they calculate it, they're looking at your portfolio.
Yeah, they look at all. Yep, that's it. They look at the positions. Like they want to see the deltas balanced in a particular contract, and then they want to see the whole portfolio. And this has got to be how they're doing it. Now, whether they're doing it 1 month, 5 months, 2 years, I don't know, but
Yeah.
it can't hurt. It can't hurt.
And the other thing too, I mean, you have all this dry powder, and even with Tom's account sizes, he doesn't jump in with 4 or 5 contracts on a certain call or put. He might have one. Most times he'll start with 1 or 2, and then he'll scale himself into that position if he feels fit. So I think it's a great point, Tom. Thank you.
Hey, Troy, can you go back several charts to that one right there?
That's a very bland chart right there now.
No, okay, sorry, that's not actually. Go to the one below it. Yep. So this is interesting because this is a more of a larger sample size. It's from 2000. If I'm reading this right, it's from 2000 January of 19 to present. Is that correct?
I don't know what the time span is, but it's a longer time span. I don't know if it's January of this year to something January 2019. I don't know if it expands to now or if it doesn't. But here, this one's very easy. It's 20 to 2024.
Yeah, but I'm thinking that 2019 one would be for about. Is that for 5 years or is it just for that one?
No, it's for that 1 month in 2019.
Is whatever time period that's for. Yeah, whatever time period that's for. It's interesting because the bonds are definitely sticking out. And you would want to definitely be in bonds
during that time period.
Or 30, the 30, 10 or 2, yeah. because of how uncorrelated they are to everything else.
You got it.
Well, but keep in mind back then, interest rates were zero or negative in some places. That's zero, the zero interest rate environment they talked about before COVID. You can remember that? Not all zero, but sometimes there were things. Remember how ridiculously low interest rates were back then?
You're right. That was 2019, wasn't it?
Yep, that was the peak of it.
You're right. You're right.
Yeah.
So it was going to swing the other way, but what that's telling you is it was totally uncorrelated to all other commodities.
Yeah. I did not remember that, but yeah, I did. I had a great interest rate on I remember that. I had a 2.8%.
Yeah, that's tough.
Yeah, I mean, they moved because of that.
That's why I'm wondering if that's a 1-year chart or a 5-year average. I'm just can't quite figure that one out because
I think it's January to what Mark said. I think it's just January 2019. I think it's just that 1 month.
Okay.
Usually he's pretty good with his titles. Like here it says 12 months. So it says 2019.
Yes, there you go. Okay, got it. I missed that part. Great, thank you.
You know, it's interesting on the first one with the cross, not that we traded, but it shows that natural gas is almost moves the opposite of everything else.
Oh yeah.
So if natural gas spikes up, energy cost going to be distributed across all parts of the economy. It's going to hurt everything. That's one way to look at that.
Well, but that's January 2000. So infrastructure for transporting natural gas has drastically changed.
Yeah, but that's for that was for 4 years. So on average, it's saying natural gas moves opposite of the other things.
No, that was 4 years.
That was a 4-year chart. Yeah, that was 20 to 24. That was
This is January 2000 to July 24.
Yeah.
24 years, not 4 years.
24.
4 years. Oh wow, 24 years.
24.
That's a good sample size.
24.
No, I'm missing it. Okay, I didn't see that. That's interesting.
Now,
Yep.
natural gas in the last 12 months or since July of 2024, it's very similar to what you were saying. So anyway, food for thought. I thought it'd be a good one to let you guys sit there and be like me and scratch it. If you have a beard, scratch it and think about it and see how you're going to allocate your.
I got a question to bounce out everybody. A strategy that I've done paper trading, and I actually did one live. So what I found out that if you go, and I'm doing this in gold, and if you go out further, like 120 days, 130 days, the volatility is a little bit more. So I went out and sold I sold a 25 in April, 2,500 put. No, I'm sorry. A May 2680 put. Okay. And I got $3,600 in premium for that. I am right now at about 27% P&L open, and I'm at $1,000. So, I mean, I'm thinking about just closing it, but
With that many days left, I think that's a great return just to say I'm out.
Yep. But the only thing about it is, so my personal feelings right now with gold is I'm not putting on any calls in gold, selling any calls, because I feel that with all the rhetoric about tariffs and nervousness in the world about the U.S. doing things or whatever that's not normal, that gold is going to slowly keep creeping up as a safe haven. And so that's what I'm monitoring on a day-to-day basis, sediment and all that, and it's slowly starting to do that. And so I'm doing good on the put side. So yeah, tomorrow I'm going to think about it hard and maybe just close it out.
Yeah, I mean, you got a nice little premium there, buddy. I mean, it's hard to walk.
Yep. I actually did a let's see, where is it? That was at 3,600 on a 2680 put, and I got $2,000 on an April 25 put, and they're both in the green. One of them is, and they're both around 26%, 27%.
You just did one contract each,
Yes.
and you got that kind of premium. That's good.
Yeah, I got 3,600 on the 2680, and I got 2010 on the 2600. They were done at separate times.
What was your buying power on those? Or what's your percent return?
It was a little higher. I gotta go look at my log. I don't remember offhand. But it was a little bit higher. But and I wasn't planning on staying these things all the way to the end. Like I'm probably gonna get out tomorrow.
So what was your put at?
Okay, so the one for 36 was 2680.
All right, so
May 2680.
in the last 6 weeks, it's been down to 26.24.
Right.
So I, like having that greater profit and still having your DTE being so far out,
Mhm.
I think that's just a nice little quick jump and get out.
Yep. And I agree. That's what I thought. I was gonna give it one more day and look at it, but I may do it tonight.
and then, you know.
Yep.
So
So
there you
anyway, that's what I was, and I had done it for a while in paper trading, and it was 100%. You know, I just go out there and look for, and these were good premiums further out than normal, and you know, and I'm looking like when the price is dropping a little bit, so it's going to be more volatile. Go out and look at those puts further out, and then me thinking that in the long run, with all the nervousness and thinking that people gold's going to just keep inching up, and so far so good. And when you say 6 weeks ago, we're talking the middle of December, right? So a lot of unknowns then, and
go.
but there's been just a lot of new stuff happening. Anyway,
Come here. No, she's
I
fine.
just wanted to give her a smooch before.
Say hi.
hi.
Judy,
Say hi, guys. You ready to sell something?
Oh,
Yeah. That's, see what I That's what I get.
I can't tell today. You never know. Is that a kid or a grandkid? You never know.
I wish it was a kid, but it's a grandchild.
Okay. You never know.
Or a great grandchild, maybe.
That's right.
When my wife and I first got together about 5 years ago, I was like, come on, let's have some more kids. And she goes, are you nuts? So I never won that battle.
It's theoretical for us. Right.
Yeah.
Theoretical and aspirational.
So anyways.
You gotta do your fundamentals.
Yeah.
Yes, you do. I'll just leave it at that. But anyway, anyone got anything else before we wrap this up for the evening?
Hey, Tom, your screen went blurry, just so you know.
Yeah. I got something wrong with the camera. I'll reset it later.
Well, we're having a heat wave here in Ohio. Tom and I are enjoying ourselves. We're wearing shorts and t-shirts around at 50 degrees.
It was sunny today.
It's sunny. And so we're going to go enjoy ourselves and